Good morning. My name is Richard Kessler, and I am Chief Operating Officer for Benenson Capital Partners and a member of the faculty at the Schack Real Estate Institute. What a difference a year makes. Last year we were wondering where would we be going and what would we be doing in 2009 as we watched the meltdown of our financial system and the worst economic crisis since the Great Depression. However, 2009, we've seen a sort of a turnaround. We've seen a new REIT formed. We've seen equity raises in both the public and private capital markets. And just this week, we've seen a CMBS transaction. So amongst this group, the small group is over $15 billion worth of available capital. According to ULI's emerging trends, they said that 2010, 2011 are going to be the greatest buying opportunity of our lifetimes for real estate. And yet, for me, this seems very different. I don't see lots of opportunities. Jay, could you tell us, what are you seeing out in the market? What are you looking for? Where do you think 2010, 2011 you're going to be finding opportunities?
Well, I think this time last year we expected late 2009 to bring us huge opportunities. But the reality is nothing's for sale. We turn over a lot of rocks. Cap rates have compressed on the sales that have occurred, the few sales, and no owners have been forced to move their assets. So where we see opportunity today are primarily new construction, empty buildings, or new construction hotels, or hotels that are negative on operations. And I think if you were here for Sam Zell's speech earlier, recapitalizations, I think, are the major opportunities today, not outright purchases in the U.S.
Wendy, what are you doing?
Well, as I said, I think we're well past the stage of being defensive about making sure that we have enough capital to deal with our own balance sheet and feel comfortably offensive. I agree with Jay, and I think most people on the panel are going to say that the opportunities, and we didn't expect them as early as 2009. I'd say we're still looking sort of for the back half of 2010 for what I like to say really just the beginning of the party. I think that until there's a forcing mechanism in the marketplace that makes people have to sell, which is either maturity dates come up and maybe the banks are going to roll, I think special servicers who are a different constituency in this marketplace than maybe, for those of us who were around in the early 90s, that didn't really exist, either because they don't have to, they don't want to, or they don't have the capital to hold on to the assets. I think we may see some forcing mechanisms as interest rate reserves start to run out and maturity dates come up where the equity is just so far underwater that, something's got to happen. It could be that we're going to see, mezz players start to take control from equity, but I think the long story short is you will see very few straight equity type deals, sales, where there's not some sort of a restructuring involved. And if you do see those, we have actually been a net seller in the last couple of months. We sold a Washington, D.C. office asset, brand new, fully leased, on an off-market transaction. We sold the building for $830 a foot at just slightly over a 6% cap rate. There's a lot of money on the sidelines. If the assets available and the equity's, clean, I think there's a lot of money waiting to do it. The distress just hasn't seemed to happen yet, but, I think it will start.
I'm not sure that I would categorize this as appearing to be the best buying opportunity ever. What I would say is that it seems to be a tale of two worlds, and we'll see if that continues. Cash flowing assets, there appear to be great demand for and a lot of liquidity. And if you're looking to make opportunistic returns or see the best buying opportunities that you've ever seen, you're going to have to be willing to take a lot of risk. Those risky deals are broken construction deals, hotels, condos. There are big risks and big rewards to be made if you're willing to take this stuff on. It's going to be all equity, and for those who have the foresight and vision and the luck to participate then in them and see the world recover. There are going to be great rewards. There are also great risks.
There's very little transactional activity, and so what's preeminent in our thinking is to maintain our strong balance sheet, our 37% leverage, and our access to capital and our liquidity to comfortably navigate through what I think is going to be an extended period of continued fundamental pressure on rents and demand. And until we see some of the improvement in the economy occur and jobs being created, we're going to continue to face that pressure. But at the same time, we'll continue to do what we've done successfully over a period of years, and that's some build-to-suit activity. We're doing a headquarters facility right now for Sanofi Aventis, and we've just completed one for Wyndham. It's worldwide headquarters, so we'll put our land to use where we can on a sensible risk-adjusted return basis, and we'll use our dry powder and our balance sheet to be opportunistic.
First and foremost, I think we continue to be patient. It's been 2.5 years since we made an acquisition in the United States. We try and actually get in front of everybody at the table here and look under the rocks before Jay gets under the rocks. Unfortunately, we're not finding any opportunities right now. That said, I think as we're looking for opportunities, I think sitting here last year, we had expected there to be a lot of distress. We had expected the banks to really be forcing more distress into the system and more transactions. I mean, clearly, if we go back to a few of Sam's comments, and if we really believe it's going to take to 2013 for the banks to come clean, it's going to be a very slow period for everybody sitting at this table, and it's going to be very difficult for us to figure out what we're going to do with the $15 billion. So hopefully I'm not spending a lot of time this year working on my golf game. Hopefully Sam's wrong, and the re-equitization that we're seeing now will allow the banks to come cleaner sooner, which I think will create opportunities for all of us. So our main focus will be on those value-add opportunities. I do agree with Wendy. I think that the opportunities will start with distress on the debt side, where there are restructures, recapitalizations, as opposed to straight asset sales. I think anybody today that has the ability to hold on to an asset doesn't want to sell at the perceived bottom of the market. I'm not sure if we're at the bottom or not today, but clearly, if you have the wherewithal to hang on to an asset, it's not something you want to be selling today. I think you're going to hang on. So we're hoping to find more opportunities on the distress side as we get into 2010.
Paul, I just read that you just bought a building, though, in France.
We bought a building in France. We have an open-ended core fund in Europe, and that was something, it was 100% lease, sale, lease back, and I think that's probably the one area today when I look at core that's very different. I think you can value assets today. I think cap rates have expanded dramatically, where in the Paris market, cap rates were pushing below 5 at the top of the market, and the asset we just bought was priced in the mid-7s from a cap rate with no rollover for the next 10 years. So I think it really is a division of two markets. Core, we'll see some opportunities, and I think that's where we'll place some capital in the short term. On the value-added side, which is more focused on distress, I think is going to take a little longer.
Well, I agree with that. The core market in the U.S. has begun to equilibrate. The NCREIF index is down between 25 and 30%, depending on which asset type you look at. And our own portfolio has paralleled that much more quickly than it did in the early 90s. There are core funds, between 15 and 20 of them out there today, accounting for over 100, close to $200 billion worth of assets. And at the point that those have been written down to the value that may or may not be the right value, but it's the value that the appraisers come up with the relatively low leverage on those assets, there's an incentive for those portfolio managers to start trading out of some of those assets and trading into new ones. And we're seeing that even in the U.S. We've just tied up a deal yesterday, actually, largest one of the year, very core, very long-term credit, strong asset, and at somewhere between 150 and 175 basis points cap rate, higher than we would have normally expected to pay for it. Didn't have to go to France to find it, but it's hopefully we'll close it. On the consolidation front, there was more consolidation earlier this year The weaker managers and weaker GPs really were pushed into the corner by LPs and their investors. And I don't know if we'll talk about the fund structure later, but we see that diminishing now as saner heads are prevailing and people are beginning to figure out how to work with each other rather than against each other. But as investment managers, our job is to work for our investors, and if you can do it by acquiring an asset, that's fine. If you can do it by bringing in a portfolio and managing it better, that's okay too. There probably will be continuing consolidation, but we don't see it as actually taking off.
Yeah, I agree with a lot of the comments that were made by the panel. If you have cash flow today, I think the result is surprisingly that there's a lot of capital chasing deals, and as Wendy said, there seem to be aggressive cap rates. So what we're finding in the opportunity side and what we're focused on is all equity bets really are basis bets, big discounts to replacement cost, big discounts to prior valuations. But if you're doing that, you have to buy broken deals. So what we're primarily seeing are busted condo deals, vacant office deals, hotels, residential land, and we are spending some time with the FDIC and looking at some of the FDIC transactions. We took a run at Chorus, but primarily, again, all equity deals, and also, typically in some sort of foreclosure auction or bankruptcy auction or being sold by the lender.
I have a few different perspectives. Firstly, in terms of level of activity, there's more this quarter than there was last quarter, and last quarter was more than the quarter before. So the trend is good, but even today the level is modest, both on debt and equity, to say the least. We are seeing a fair amount of activity in the lending side, mortgages, B-notes, mezzanine. There's a surprising amount of capital, debt capital available for those who need it for income-producing properties. And for the reasons that Sam mentioned, I think most of the equity activity is related directly or indirectly to recapitalizations. And for a host of reasons, it's very difficult to make a deal, and it takes a long time to get the deal done. And so the question is why, and I think there are a couple of interesting things going on. Number one, as everybody knows, the fundamentals in terms of the supply and demand for most of the property types are weak and are likely to be weak for another 12 to 18 months or so. So it's tough to underwrite any rental growth through the projection period. And the CapEx is a lot higher than it used to be. So you take that into account and you try to provide some margin for potentially higher interest rates in the intermediate term, and you come up with a null set frequently in terms of a consensual equity transaction. So I think there are understandable reasons why it's been slow. It's also interesting to me in terms of the lending environment in general, and I do think that that is improving. But, at Apollo in the non-real estate area over the last 18 months, just in terms of corporate deals, we probably invested, over $5 billion of equity and over $20 billion of different types of debt acquisitions at a discount, primarily from money center banks. And the money center banks, in many cases, provided financing. So that's a lot of activity. And sort of invested through the trough in the end of last year and the first quarter of this year. So you take that as a data point, and certainly Apollo was not the only one who made those investments. A number of other private equity and credit firms made similar investments. But then you go to and there was some real estate, mezz and other loans included in that as part of a portfolio transaction, but probably 75% of it was straight corporate levered debt, term loan type of financings. And then you take a look at the real estate world, and that has not happened by and large. And I think that it's coming. I think that we're probably another 6 to 12 months away from different financial institutions being in a position organizationally and financially to start clearing their books. And frankly, I think the reason it's happening 12 to maybe 18 months later than it might have is some of the government intervention that's happened with respect to mark-to-market rules, with respect to how bank examiners will review modified loans and things of that nature. But I think that's been an inhibitor to the market clearing. But there are signs that we're going to start to see more of that during next year and probably even more so in 2011.